This is the DeFi Decoded podcast by 9 Point Partners in cooperation with Prophecy DeFi. The ideas and opinions expressed in this podcast should not be taken as investment advice. Always consult with your financial advisor before investing.
Hello, and welcome back to another episode of the DeFi Decoded podcast. I'm Alex Tapscott here with Andrew Young. Andrew, October is supposed to be a spooky month, but it's been nothing but green candles and happy vibes since we started. I think the S&P and the NASDAQ are both up like 4 or 5% in 2 days. Crypto's caught a bit along with other risk assets, and yet somehow the move in the markets is not the biggest story. The biggest story is that Elon Musk has announced, I guess because he thinks he's going to lose this court case, that he is going to buy Twitter after all. And as a result, the market actually believes him this time. The stock's trading up to, I think, over $50. I think the implied price for the deal is around 54. So still a pretty healthy ARB spread there that people may be discounting it, but actually tighter than what we've seen at any point really in recent memory here. So this is a big story, and it seems to be kind of driving markets, or at least driving attention. What's your take on what's going on with Twitter, and how does it relate to?
Yeah, exactly. So there's a couple of things. So first of all, I also turned on CNBC and saw Cathie Wood was on it, and I immediately knew that the NASDAQ was up, and it was up 4%. We always get Cathie on CNBC when the NASDAQ's ripping. So good to see that. Crypto has actually been sort of decoupled over the last couple of weeks. It's been outperforming to a certain extent while stocks have gone down. So that's been good to see. But yeah, no, the big news of the day obviously is Twitter. Looks like the Twitter deal is now going to go through after it essentially became clear that Elon was going to lose the court case. So what's really interesting about this is actually what happened last week and how this relates to crypto. Is because of this court case, a ton of Elon's private text messages were leaked to the public. And the concept of actually making Twitter fully blockchain-based and decentralized came up multiple different times with different people. So the first interesting sort of conversation was with Jack Dorsey, who is the former CEO of Twitter. And besides kind of just being angry with the board, one thing that he talked about a lot was about how he thought Twitter should not actually be a for-profit company. It should be structured as a foundation and built on essentially a blockchain to actually make it fully decentralized and fully permissionless. And the fact that they couldn't do that as a public company, Jack claims is like one of the big reasons that he left. So that was kind of the first really interesting exchange was between Jack Dorsey and Elon. The second, which is also fascinating, was between Elon and Sam Bankman-Fried. So this guy, William McCaskill, who's sort of a mutual, call it philosophical advisor to both of them, actually put the two of them in touch to essentially have Sam help finance the deal. It was actually kind of funny because Elon didn't realize that Sam was this crypto billionaire, and this whole exchange where he's like, well, is he rich? And McCaskill's like, well, he's worth 24 billion. So is that rich enough? And it's kind of funny for people who are in crypto for someone to question whether sort of SBF was actually rich or not. But anyways, one of the things that's interesting is SBF actually brought up the same exact idea of making Twitter, essentially once Twitter became private, actually turn it into a fully decentralized blockchain-based sort of alternative. And they actually go on this for a little bit, and there's some pushback from Elon, which I'll get into kind of at the end. And then finally, there's actually some mentions from Elon to, I believe it was to his brother, talking about the idea as well. And it was kind of interesting. The idea was they would use Dogecoin as kind of the underlying gas currency to meter usage on Twitter. And the idea was that they could get rid of bots by making everyone essentially pay a very small gas fee denominated in Dogecoin every time they want to post on Twitter, which it was kind of interesting to see Elon sort of take it take the idea himself and actually sort of envision what it would look like. But the last thing before I sort of turn it over back to you is Elon actually pushes back against SBF, if I sort of remember correctly, going through the text messages. And his main sort of counter to this idea of making Twitter fully decentralized is that he doesn't think it's too computationally expensive at the moment to do so. And he thinks that there's just far too much data that's being generated by Twitter. And so the nodes in this sort of proposed decentralized Twitter network would have to be so big in order to actually allow the service to function, or the app to function, that in the end, it wouldn't actually be a peer-to-peer network. It would just be a couple of very large data centers sort of serving as the main nodes. And Elon essentially concludes that it just kind of ruins the whole point of going decentralized in the first place. It would just be too centralized. So he essentially just makes a technology-based argument against it. In terms of sort of philosophically, he actually seems to be quite in favor of it, and especially this idea of not making Twitter nonprofit, which, as we know, in crypto is actually very common. You see things like Ethereum Foundation, which is nonprofit, and then obviously the network itself sort of functions on its own. So yeah, it was really interesting to see, because people have been speculating about this for a while, that Elon could turn Twitter into a fully decentralized sort of blockchain thing. And it was actually really interesting to see that it was proposed multiple different times and actually sort of proposed by Elon himself. So, and I guess the last thing is, I agree with sort of Elon's, the problem with Twitter is it's almost too big. You can't really port it over into a decentralized network and actually have it function. But that argument may not hold up over time, in the sense that, like, those technology barriers and cost barriers to actually running a sort of $100 million user social network on a blockchain, because it's just too computationally expensive, that actually may go down over time, because we've seen blockchains get faster and cheaper over time. And so there's sort of an argument to be made that he essentially concludes that it's not ready right now, but I think long term it may make sense.
That's definitely an evolution in his thinking. I think he's always been interested in Dogecoin, but the idea of looking at it at a protocol level, I think, is something that until recently, I think he's been quite skeptical of. So that to me is sort of kind of interesting. You know, people might ask, well, what does this mean exactly? Why is a company not the right model for a network like Twitter? What would a protocol do differently or better? Like, why is that a desired end state? And there's actually some interesting literature around this. Brad Burnham, who's one of the founders of Union Square Ventures, actually said that he thinks tokens are the native application or the native asset of the internet. And in the same way that, you know, the corporation was the way in which we raised capital and organized capability to do something in the industrial economy, because industries were capital intensive. You want to build a railway, you've got to have a lot of shareholders. They've all got to pool their cash and build something. In the same way that a corporation was the right model for the industrial age and maybe the early information age, tokens might be a better model for the world of Web3 or the digital economy. And the argument is basically, you know, we've tried to graft corporations onto networks, but maybe companies and networks are incompatible. The purpose of a company is to maximize profit for shareholders. The purpose of a network is to grow, to maintain network health, and to interconnect with other things. So as a company, you might make more sense to close your network off. So Twitter used to have an open API, and now it does not. Android used to be much more open, now it is not. Facebook used to be much more open. There were third-party app developers building on top of Facebook, and it closed that off. All those companies realized that in order to maximize advertising revenue, advertisers wanted a controlled experience. They wanted to know what they were getting into. And so doing it inside of the confines of a company that was closed off from the rest of the world actually made more sense. But what did that do to the networks themselves? Well, it made them less healthy, right? It made them less useful and it made them less connected. So the idea basically is with a protocol model and a native token, you can incentivize not only users, but also so people who are like reading tweets, but also people who are doing the tweeting themselves, tweet to earn, they can become stakeholders, but also you can promote development on top of the platform and allow that network to continue scaling. One of the tweets, I think, or one of the text messages from those exchanges that caught a lot of people's eyes was when Elon sent the CEO of Twitter a message. His name, I think, is Parag Agrawal, and said, "Is Twitter dying?" And there's this concern that Twitter is an ad-based model; it's just not working, and that it's at least in a state of stasis, even if it's a must-have application for people like me and you, that it's not actually growing and thriving like an organism should, like a network should. And so I do think that there's a lot of logic to that, but I do think the idea that trying to move something that already exists as a company with users and all the rest of it, employees and everything that goes with it, into a networked state is actually extremely challenging. But starting from something from scratch is not. And that's why a lot of NFT games and guilds and DeFi projects and the rest of it start off as DAOs to begin with. They start off as organizations that are native to Web3. They may have companies that do development for the protocol, and that's a separate matter that deserves its own episode. But in general, like, the idea is that the thing itself is a decentralized organization. It exists at the protocol level. Doesn't look like that's going to happen this time around for Twitter, but it is something that I think the next Twitter is going to look a lot like.
Yeah, I totally agree. And you're starting to see the first couple sort of blockchain competitors come live. The big one is obviously DeSo, which is sort of stands for decentralized social. And it went viral about a year ago. And the way that it was actually a really cool model. Essentially, everyone on Twitter had their own sort of social token that you could buy. It was almost like a meme token. And the idea was it almost creates like a market cap for Twitter influencers, and really leverage the sort of one of the core value props of crypto to me, which is the sort of financialization of everything. And in this case, it's sort of financialized social clout and made it a sort of new tradable asset class. And that was great. It actually led to a ton of people using the platform, a ton of speculation. But then the problem was that the sort of organic demand or organic usage of the platform flatlined. And so the speculation also flatlined. And now it's in a scenario where this doesn't really have, it still has like a bit of a core community, but for the most part, it's kind of died a bit. And so you really need to, it's like one of those things where you can have the best tokenomics in the world and the best what are called Ponzi-nomics or whatever you want to call it, and create these awesome network effects. But if at the end of the day, the underlying application is not fun or useful to users, then everything will just kind of fade away.
Yeah.
And so what's really cool with Twitter is that it already has that organic audience. So if you were to strap on these sort of financial incentives in the form of tokenization of social profiles or like a Twitter token and all sorts of stuff like that, that would be really, really cool. And actually has a much better, much more sustainability. And at the same time, you solve a lot of the issues that people think plague social media today, like censorship, the fact that no one owns their own data. I mean, there's just a lot of bots, all the stuff you sort of also mentioned as well. So I think I'm still kind of optimistic that maybe Twitter eventually will actually be the first one to do this, especially if it goes public or private, I should say. Particularly if we get another crypto boom and we also get a increase in scalability to the point that a Twitter network or Twitter chain is more feasible.
Yeah.
And so, yeah, I think, who knows? But I do think there's enough demand for a sort of decentralized blockchain version of Twitter that it will eventually happen. And whether that's crypto native or actually just turning Twitter itself into a blockchain-based version of itself, then I think it's kind of inevitable. So I'm definitely very optimistic about that. One thing, because don't want to spend too much time about Twitter. One thing I saw in the news was MasterCard seems to be making a big push into crypto with their new tool. I know this is something you've sort of covered in the past. Sort of what's happening with MasterCard?
Yeah, I mean, the announcement itself is really interesting. MasterCard is obviously a giant payments company, one of the two largest, with Visa, worth hundreds of billions of dollars in market cap. And I think people forget, but as one of the original fintechs, payment card networks are a technology that has made finance and payments, easier, faster, cheaper, more global. And so to me, it's not totally surprising that we see a lot of innovation in crypto, or at least a lot of openness to crypto and Web3 coming from these companies. But what to me is really interesting is that MasterCard is kind of doubling down on crypto assets specifically. They're not saying we want to launch our own MasterCard stablecoin and maybe we'll do it on a public blockchain, maybe we won't. What they've announced is a product called Crypto Secure that basically helps banks assess the risk of crime that are associated with crypto merchants on its network. And it's powered by this company called CipherTrace, which is the company that they bought last year. The reason I think it's significant is it demonstrates once again something we talked about last week, which is that enterprise adoption of crypto assets and public blockchains continues to accelerate despite the fact that the market is down. A lot of Web3 developers and VCs who need to be in this space are obviously going to tout the benefits of Web3 even when things are down. But a lot of big companies don't need to unless they think that there's something significant going on and they need to be there. And I think the quote in the press release from MasterCard was really the most revealing. This guy, Ajay Bala, who's the president of cyber intelligence, said, "These are market cycles. They will come and they will go. I think you've got to take the longer view that this is a big marketplace now and evolving, and it's probably going to be much, much bigger in the future." And I think that's a big shift in terms of how big companies think about digital assets, crypto assets. There was a period in the last bear market where a lot of enterprises who were working on proofs of concept and other pilot projects kind of just pulled back and didn't do very much. And others maybe who hadn't started, who kind of probably wiped their brow and said, geez, it's a good thing we didn't end up doing anything. This time around, the markets are going down, but people are still plowing ahead. And that's because these initiatives are taking on a more important role, I think, in these organizations. I think a lot of companies see the potential here and are probably using a down market to do what crypto people tell each other, which is to build and to prepare for when this market does become, in Mr. Bala's term, much, much bigger in the future. So this is a significant trend. It's one that I'm certainly watching for 2023. And I think it's something that I think everyone should be paying attention to. And by the way, it does have an impact on the investment case for the asset class. It's not just about, headline, wins. This is something that if people are going to use more crypto assets, and maybe MasterCard makes it easier for banks to integrate with exchanges because they have risk management tools. Maybe, more and more companies are using public blockchains to launch NFT projects, credentialing projects, payments projects, whatever. It's going to end up accruing to the bottom line or to the protocol level, right? So there's an investment story here as well. And that's something I think is very important. By the way, it's crazy to think, but we're in October. We're going to have to get Ryan Selkis back on the show for a repeat of last year's episode where we do our predictions for next year. I was just at the mainnet event, as were you. We did that on the last episode. His predictions are always good. So I don't want to overpromise and underdeliver, but we're going to have him back on to talk about some of these big trends.
Yeah, for sure. I'm really curious to hear. First of all, I totally agree with everything you said on the MasterCard front, and I think you're spot on in terms of the enterprise blockchain sort of angle. But yeah, no, I think I'm really curious to hear what his predictions are for next year. It's going to. I feel like the macro environment is so uncertain at the moment, and it does seem to be driving a lot of the things that are happening just overall in the crypto market. But at the same time, it does seem like crypto, it just seems poised for a huge recovery. And that may just be my my bullish bias showing, but it's going to be interesting to see over the next kind of 6 to 12 months what's going to happen. But yeah.
Well, to paraphrase an old expression, hopium springs eternal. Andrew, that's it for today. Great episode. Nice chatting with you on the Twitter thing. I'm so glad that one of us read all of the information that came out of the Twitter thing and all these text messages. It's nice to see how the other half lives. My favorite one, actually, just before we go, was Larry Ellison says, I'm in. And he says, how much do you need? A bill? And Elon says, I don't know, man. I would put in more, maybe 2. And he's like, okie dokie. And it's like $2 bill in the can for the deal. It's like, man, if only it was that easy to raise money for, the rest of our projects. All right, that's it for today. Thanks everyone for joining us. We'll see you next week on another episode of DeFi Decoded. Take care. Bye.
The information contained herein does not constitute an offer or solicitation by anyone in the United States or in any other jurisdiction in which such an offer or solicitation is not authorized, or to any person to whom it is unlawful to make such an offer or solicitation. Prospective investors who are not residents in Canada should contact their financial advisor to determine whether securities of the funds may be lawfully sold in their jurisdiction.